bit fancier. We're going to say, I'm going to create a holding company LLC, and that's going to own each of my LLCs that hold each of my properties. This sounds like really good legal planning advice. My attorney said, oh, don't worry about it. This doesn't cause any problems from a tax perspective. I mean, federally, they're 100% right. Federally, no problems whatsoever. You want to go to the state of New Hampshire, you've just created some real headaches for yourself. So we're going to talk through 2 issues specific to the state of New Hampshire. So the problem number 1, New Hampshire looks at each of those LLCs you created for each property as a regarded entity. They don't care that it's 100% owned by your holding company or 100% owned by you personally. They say that is a separate business entity, and I am going to tax it as such. So if you buy 20 properties and each one is in a separate LLC, and you might file one federal tax return, like great, the IRS doesn't care. They think all these little LLCs down here are disregarded. And the state of New Hampshire says, nah, I don't think so. All those regarded. So now you have one federal return, and you could have up to 20 New Hampshire business returns to file. That is a nightmare. It's a pain, and I'll say it benefits me, but it's expensive. It's a lot to deal with every single year. So, in some cases, it comes. You say, well, my property it's under the gross receipts threshold. New Hampshire looks at each LLC and says, all right, well, if your gross receipts, your total rents collected are under a certain number, and it's inflation adjusted, it's around 110 grand, then you don't have to file a New Hampshire business tax return. It's like, all right, well, so all my entities are under that threshold. Great, this is all good. Well, what's the other problem here? Well, what happens when you sell a property? Well, now your gross receipts are definitely going to be over 100 grand unless you're just selling mobile homes. So now that will be a tax filing that you have to make in the state. And now any losses that you've accumulated in all of these other properties that you have, you can use them federally, that's great. But New Hampshire doesn't care, they look at that in a silo. So you can end up paying an additional 7.5% to the state of New Hampshire on your gain on sale that you were not expecting to pay. So paying attention to this structure is extremely important. All right, so how do we fix this problem? Because I'm not going to tell you, it's like, oh, you should blow up all the legal work you did with your attorney. No, that's probably not a great idea. I mean, if you're not respecting the LLCs, might as well. But in any case, it's like, okay, well, how can I fix this? Well, New Hampshire has this odd caveat called a water's edge filing, where they say, well, if you're doing business in New Hampshire and outside of New Hampshire, now you get to roll all of those together into a single New Hampshire business tax return. So now so let's say that we have a guy who has 20 properties, who each in an LLC, they were all in New Hampshire, and then he goes and finds a trailer somewhere up in the middle of Maine, and he says, I'm going to buy that and I'm going to rent it out. It costs him 100 grand. Well, now suddenly he has a single New Hampshire return. They all get roped together because he has operations inside of New Hampshire and outside of New Hampshire. So then now he can use losses from some activities to offset gains or income in others, and it just makes life a bit easier. It then kind of mirrors what they're doing on their federal return, where on their federal return, it is all lumped together because the IRS says, well, these are wholly owned, I don't care, they're disregarded, we're just being treated as a single tax return. So buying that one property outside of the state, you've now accomplished the same thing within the state of New Hampshire. Does it make sense? Absolutely not. But that's how the rules are written. I've talked to a few very well-respected attorneys on this. Arguably there's constitutional issues on this in New Hampshire, where two taxpayers in identical situations could be taxed differently just because they happen to buy one little property or have a little bit of business in another state. But that's the way it is. That's the way the rules are written. All right, so New Hampshire structuring headache number 2. So New Hampshire compensation deduction. So this is a little bit of a difficult one to explain, but as we know, New Hampshire likes to say that we have no income taxes. As business owners, we know that's not true. There is the New Hampshire business tax, but what New Hampshire wants to do with that is to say, okay, well, we at least want to provide people a provision to say, well, whatever they should have paid to themselves as wages or whatever, I'm not going to tax them on that. So they call that the compensation deduction. It's a lot of fuzzy math, you know. They're saying it's like, a lot of times it'll be based on self-employment income, it could be based on the size of the property, it could be based on a management fee. Really, you just need to have an arbitrary way of, well, what's the payment to me for my services on this property? But why this matters is like, all right, well, whatever I can justify for this compensation deduction saves me 7.5% in New Hampshire business tax, so that's pretty good. But all right, we have a problem here, is that compensation deduction is only allowed to quote unquote natural members. So what's a natural member? Well, it's certainly not another LLC. So if you created a Holdco LLC that owns all your LLCs, well, all those lower tier LLCs, they don't have a natural member. They have another LLC as a member. So you can no longer take that compensation deduction. So now you could be subject, you know, maybe not matter as much upon the day-to-day operations. You know, maybe perhaps you're kind of breaking even, but say you sell, well, that's huge. You know, that could be tens of thousands, or depending on the size of the property, hundreds of thousands of dollars that you're now paying to the state of New Hampshire because of the structuring profile. So the way to fix that is a management fee, just a justified management fee that you're saying, oh, I'm just paying this from my lower tier entity up to my upper tier entity. And federally, the IRS says, well, I don't care, you know, you just took money out of one pocket, put it in the other. State of New Hampshire, they're looking at each of those LLCs as that they respect them, they're each their own standalone entity, and they say, all right, that makes sense. So now you just move that money uphill to the Holdco, which has natural members, and now you take your compensation deduction. Is it ridiculous? Absolutely. But it's a New Hampshire tax structure problem. And if you're not doing it right, they can certainly audit you and say, well, no, you don't have any natural members. You don't have any justification for taking this deduction. And now you can be hit with substantially more tax than you might have been expecting. All right, and we're doing great on time here, Mike. Closing in on 45 minutes. All right, so yeah, so this is just some kind of bonus at the end here. And I put this as, so I talk to a lot of clients that come in that have been working with a generalist, or they've been doing stuff on their own. And we end up going through a series of questions and issues, and a big part of it is, well, just the volume of questions that no one was asking them can be a substantial problem. And if whoever you're working with, you know, if they're asking you these questions or half of these questions, that's awesome. If you're my client, there's a number of them in here, and I haven't asked you these questions, you know, please don't send me any angry emails, but we'll try and talk about it. But the idea here is just to make sure that whoever you're working with is actually qualified to work on the real estate issues that you have. You know, maybe if you have a very simple operation, you're keeping it pretty straightforward, you might not need much specialized help. But the idea is, you know, are they asking the questions that are specific to the industry that you're working in and the number of tax breaks that are available in this industry that you're in? So walking through, like, what is your plan for this property? That can matter if it's a short-term hold, long-term hold, if it's a, you know, if it's short-term rentals like Airbnb, VRBO, if it's a flip, if it's just inventory, if it's a wholesale project, whatever. Like, if they're not asking what you bought it for, they have no idea if they've gotten the tax treatment right. What's your level of participation? We walked through those passive activity loss rules. You know, that's a pretty deep place to get into. Do you have any DSCR requirements? You know, if you have debt service coverage ratio, a lot of times the banks are just looking at your tax returns. Are you presenting your tax returns in a way that makes sense for the bank and they're not going to paint you in a bad way? I mean, I'm not saying lie to the bank, but I'm just saying, you know, maybe you can present it in a different way that's going to better tell the story. You know, if you have any partnerships or LLCs, can you send me a copy of the operating agreement? You know, the number of times that I've seen and talked to someone who's like, all right, well, you know, yeah, so who owns this? And you're like, oh, it's just me, I own it. And you say, oh, can I see the operating agreement for the LLC? And then they send it to you, and it's like, well, it's you and your wife. And it's like, well, yeah, So, well, it's not just you. You don't live in a community property state. Now you have a partnership tax return. So just, that should be something that's always provided to your accountant. Copies of your loan agreement or key provisions. They're going to need that in order to properly report the tax provisions or deal with, if it's a partnership, deal with the debt guarantees or if there's any indemnities between partners. All of that is information that they should have. The nature of those debt guarantees. It's pretty common that, maybe one partner guaranteed the debt and all the other partners sign a side deal that says, well, if this guarantee is ever called, we got your back, we'll cover our piece of it. What did you do with those cash out refinance proceeds? You're supposed to trace that interest expense. If you did a cash out refinance and bought yourself a nice boat, that interest is no longer deductible. You have to be able to trace those proceeds to what they were actually used for. Can you provide me with more details on those renovations? The number of times where I get a fixed asset schedule, so it's a building improvements for $100,000, and no one asks any questions. Well, what did you actually do? Really going into that detail can change what we can do from a tax perspective to accelerate deductions, take some bigger losses, or maybe we don't even have to capitalize it at all. And then, cost segregation study. Everybody wants to do it right off the bat, but it doesn't even make sense for your given tax situation. Maybe we wait a year. Maybe you're gonna have a big gain event in a year or two, and we can wait and do the cost segregation studies then. So a big timing component to that. And I think that's about it there. So we'll